Hello, everyone. Welcome to the November 2023 real estate market update with Catalyst Funding. As always, we want to bring you the latest and greatest on the real estate market, especially in the state of Texas, with the great updates we want to bring you from Houston, Dallas, San Antonio, where we have loan officers on the ground and where we have expertise to help you. With that being said, I'd like to introduce Wade Comeaux, Catalyst founder and CEO,
Hello, everyone.
as well as Jeff Johnson, our director of lending.
Hello.
And we have a special guest. We're having a little technical difficulties, but we have a special guest that'll be joining us shortly, Steve Rozenberg. And so we'll get him on as soon as possible. But Steve is a well-known international speaker. He's a writer with bigger pockets, so we love to partner with as well. And so we'll get that worked out with Steve here shortly. That being said, let me offer a quick disclaimer, and then I'm going to let Wade and Jeff get started. This presentation is for general information only, and any information we provide here, we just want to be a benefit to you, but any determination you use for your own investment performance, we are not liable for that, nor our special guest, but we do hope that you find this valuable as you proceed further on your investment journey, which we want to be a part of at Catalyst Funding. So with that being said, let me turn it over to Wade and Jeff, and I'll continue to troubleshoot here with Steve.
Perfect. We can go to the next slide, please. And yeah, we'll go ahead and go to the Catalyst value proposition. That's perfect. We'll introduce Steve whenever he's able to make it on. So just to let everyone know what our value proposition is. Many of you have already heard this, but we'll walk through it. We pride ourselves on being a one-stop shop for hard money and permanent financing loans. So hard money is the money to purchase and repair distressed real estate. And then we also have long-term options if you want to be a landlord or buy and hold investor. We pride ourselves also on being built by real estate investors for real estate investors. So we have a large rental portfolio of our own that we manage in another division. And then we also have been involved in thousands of transactions over the years. We try to bring that experience to you to help you avoid mistakes and succeed at the highest possible level. If you work with Catalyst, you have a single point of contact who's fully licensed as a contact for all your loans, be it the short-term or the long-term loans. We have 5-star customer experience across all different platforms, such as Facebook and Google. And we have some excellent products for non-qualified mortgages as well. And we offer primary property refinance, purchase, and cash out. So if you're looking to fuel your real estate investment goals with a cash out transaction, either on your primary residence or on your rental portfolio, we can definitely help you out with all of that as well. So I think that's a good summary, and we can go on to the next slide. Jeff, you want to tell us a little bit about what's going on in Houston?
Sure. Next slide, please. There we go. Okay, so in Houston last month, there was, we'll call it just shy of $3 billion in total dollar volume, 40,000 listings. That's up 12% year over year from last year. If you look at pre-COVID numbers, if you look at pre-COVID numbers, it's down 6%. Single family sales, 6,377 versus 6,600 last year. So a little bit less, 3% fewer sales, but that's probably to be expected given the current interest rate environment we're in. Average sales price of 403.5, which is actually up year over year, 401 last year. And then obviously if you look 4 years ago, which we always try and look long-term, you're buying that same property for 300K, you're selling it for 400K this year. So a 35% jump in just those 4 years. Median sales price, pretty similar, 327 versus 330 last year. There's Steve, slightly down, but again, over a 4-year timeline, way up, plus 36%. Months of inventory is creeped up to 3.6, still below pre-COVID numbers. Pending sales, 6,600, which is more than last month. So And if you look at the previous numbers, that would lead me to believe that it's going to be a little bit bigger month next month in November. And then days on market, 47 days on market, as opposed to last year it was 43. So they're up 4 days, but not too many. Steve, welcome. Glad you could
Hey,
get on board and overcome
sorry about
your
the technical difficulties, guys. I apologize.
No problem. No problem at all. So, when I look at Houston, given the rates and all of the competition you see out there from new builds, like it's encouraging that the prices are holding steady. And everything I read is that if and when the interest rates start to come back down, there's a lot of pent up inventory, and it's just going to be kind of a floodgates where you're going to see a lot more activity coming out as soon as those rates start dropping. I mean, when it's going to happen, who knows? I read reports that say spring of next year. So that's to be, you can debate that, but I think it is. I do believe that if and when it does happen, you're going to see a lot more activity in the real estate market quickly. I don't know if you guys have a chance. Steve, I know you just popped on. Have you have a chance to look at the Houston stuff? And we'll go back and let you introduce yourself and talk about what you and your team are doing. But did you or Wade have any comments on Houston?
Yeah, listen, I think, Houston is proving to be one of the strongest markets in the country, right? I mean, maybe it's the best loser of all losers, but it's still the best. It's one of the best. And, despite what the media and the way they want to twist and turn things, at the end of the day, everyone needs a roof over their head. A very large percentage of Houston rents, which means somebody has to own those properties, Um, and this data it's to me it confirms a lot of information, but the reality is this isn't new to any of us, right? We all know that there's challenges and issues. It's kind of like trying to assume that you can water ski in Minnesota in the wintertime. It's just not that season for it, but there is a season to snow ski, and there is opportunity, and there's a lot of people that are going to be very successful. I've been talking personally to a lot of friends of mine that are very high level, investors and lower people that have been kind of waiting on the sidelines. And so you can look at this two ways. You can say, oh my God, it's dark out. Or you can say, wow, I got night vision goggles, I'm going hunting. And so I think, it depends on how you want to look at the day. And I think this, to me, I look at this as a great opportunity because I can go hunting when everyone's running out, contrarian, I'm going to go running in. Listen, we're all a little older than probably the average, and we remember 2008. And it shocked me after 2008 how many millionaires were made in real estate, 2009, 2010, as opposed to prior. And look, if we look at those days, I remember turning on the news every day here in Houston, and every day another bank was falling. We were going off the deep end. Nothing was ever going to be the same. They glorified it. And you look at it now, and it's a small blip on the graph radar. When we lived it, it was amazing. It was not amazing in a good way, amazing in a bad way. So this isn't even a blip. This is just a little nod, in my opinion, but it's a nod enough to bring prices correcting. Everything's going to, real estate is a pendulum. It swings one way and it swings the other. Where you want to be when it swings, this is telling me that the numbers are very clearly telling me this is hunting season, or it's about to be. And listen, we all know rates are going to come down. They always do. They go up, they go down. We've all been, I hate to say we're old, but we've been old enough to know that these rates that we're seeing now were very common back when I was, first starting 2003, 2004. So again, you don't know what you don't know, right? So someone can look at this and go, "Oh my God, the sky is falling," and we go, "It's actually just correcting. It's doing what it should do." Because if it kept going the other direction, it would make it unaffordable for investors to own properties, for people to live in properties. It would be unattainable for anyone. So the market always has a way of digesting, a bad meal and correcting itself. So to me, I look at this as good, promising news for the correction for me to buy good investment properties. I don't know if that's what you wanted to hear, but that's my perspective.
No, I would agree with that. I mean, really, there's not much of a correction in Houston to speak of. Honestly, it's been relatively flat. It's not going up the way it did in COVID, whenever rates were incredibly low and there was scarcity of homes. What Jeff mentioned earlier, I think is accurate, that there's a lot of pent up demand because there's not as many homes on the market as there were prior to COVID. There's a lot of pent up demand there. Sales are down, but the home values are not. That's the thing. The average sales price is up 0.4 year over year. A lot of people predicted a significant pullback. Median sales price is down under 1%, relatively flat, but still up, both in the median and the average, about 35 and 36% since, pre-COVID. So I see, to your point, a lot of resiliency in the market, which is really important. We're going to go the remainder of the presentation to talk about some of the reasons that we feel, despite very high interest rates, there is so much resiliency in the market. And also, I think a good prognostication for the future because of the things we're going to talk about as well. Some of the Texas market, general economy, and other factors. But
Yeah.
I think that's a good recap here. I would like to go back and introduce Steve for those of you that may not know him. If you don't mind going back a few slides, thank you very much. So I'll tell you a little bit about how I know Steve. Steve and I have known each other for quite some time. He had a very high performing and very strong reputation company that he managed a significant amount of properties. He eventually sold that company, but Steve has been in one of the more prominent people in the local Houston and Texas and really national real estate market. He does speak a lot, on a national stage as well, but we think he's an excellent resource, and we like to bring him in periodically to bring his not only to Texas understanding of the market, but a national understanding as well. So really excited to have you here today, Steve. Tell us a little bit about what you're up to other than being on our podcast today.
Yeah, Wade, Jeff, thank you guys. Great to see you again. And again, I apologize for the challenges with technology. I'm actually down in Buenos Aires, Argentina right now. So
Oh, wow.
little challenges. Yeah. So so my background, I am a commercial international airline pilot. I fly local for United Airlines. I fly Boeing 777. Been doing that for 25 years. And I started getting involved in real estate after my furlough notice from 9/11. And started buying real estate. And, as many of us know, real estate has a way of correcting when you buy bad properties. And I was guilty of that. I bought a lot of bad acquisitions. Because of that, me and my business partner were forced to create a management company because nobody wanted our bad properties. So we had to kind of do our penance. And we learned how to build a company, and we used that based on my knowledge as an airline pilot. So we created processes, procedures, structures, checklists, emergencies. The same way we do it in the flight deck as a pilot, we injected that into our company. We scaled that company from 0 to over 1,000 properties, operating in 3 major cities in Texas. 60% of our company was outsourced to virtual assistants in Mexico because we were so good at right person, right seat, scaling our company. What that led to is a very large venture capital firm came and acquired us. So we exited that deal, sold to venture capital. I became a vice president with them in charge of investor relations. They had 10,000 properties and a lot of money behind them. They kind of got me in front of Bigger Pockets. I started doing stuff with Bigger Pockets. That kind of ramped up my real estate notoriety, if you will. And I had a podcast show or a Facebook show on Bigger Pockets. I've become very good friends with a lot of the well-known names that I'm sure everyone here knows about, Brandon Turner and other people. I invest with them. I'm friends with them. I've gotten in that circle, not because I'm smart, not because I'm a great investor. I just understand the value of leverage. Just like, Wade and Jeff here today, being successful is all about leverage, and I'm all about taking in knowledge, not letting my emotions. I park my emotions at the door. I look at the data, I look at the analytics, and I make a decision on that. I've learned that there's 2 types of people. There's the scared person and there's the successful person. And we all have 2 of those people inside us every single day. And every day we wake up, we make that decision of which one are we going to be. And unfortunately, I think the news and the drama that they like to brings on that scared person out of us and causes us to retract. The successful people like Wade, Jeff, myself, Brandon Turner, all these other guys, we're bullish. We're moving forward because we see the opportunities, not because we're smart, not because we're daredevils. We're actually probably more calculating, but it's because we've taken the time to educate ourselves. We look at the data. So I guess where I'm going with this data and this numbers, it may be boring to some people, but it's telling us a story. it's telling us information that could be very, very useful that I saw personally in 2009, 2010, 2012, made a lot of people a lot of money. And I didn't understand it at the time. I thought these guys are crazy. The market just crashed. What are you doing? Why are you buying real estate? They were the smartest ones because they were prepared. So I don't know if that's what you wanted to hear, but that's my story.
That's great. That's really good. And every time Steve comes on, he brings some really interesting takes and some insight that I think our attendees really enjoy. So let's dive back into it if we can. We'll move back over to Dallas, which Dallas has been arguably the hottest market in the state for some time now. While Austin was arguably the hottest for a while, they took a big step back, and Dallas just really hasn't seen that nearly as much as Austin has. But if you look at it, year over year sales are down a little bit, but up from a pre-COVID level in total dollar volume. The total active listings are definitely down. It is a tight market. Not as many people are selling. We'll show a little bit later. A significant portion of the new home sales, larger than it's been in a really long time, are new construction, just because people are not giving up their 3% rate in order to buy another home at today's current rates. So but people are still buying homes. They're just not as many selling them. So that's why the new construction is such a big part of it. But if you go through the average sales price here, year over year up, Houston was basically flat. It's up about 3%. Median sales price relatively flat, down slightly. But look at the number from pre-COVID, up in both categories, up over 50%. That's a really incredible number. Days on market are less than pre-COVID and less than a year ago. And the months of inventory is up slightly from those two previous numbers. But overall, Dallas is a really, really strong success story for weathering very high interest rates. And it's fantastic economy, so many jobs move into that area, so many major corporate headquarters. It's a great success story for sure.
Yeah, the one thing that stood out with me on this is if you go back and look at the Houston chart, there were roughly 40,000 listings and 6,400 sales. So if you go to Dallas, compare those two numbers. We used to talk about velocity. Look at the difference: 20,000 listings and 6,000 sales. So literally half the amount of listings are generating roughly the same amount of sales. So in Dallas, you put a deal on the market, it's going to go a lot quicker. I mean, it is still very robust. And the other thing I was going to say, kind of piggybacking on what Steve said, talking about opportunities, people being scared. Anecdotally, the cash out of pocket we see on most of our hard money loans these days is significantly less than what it was in the good times, right? Because everyone was an investor, everyone was excited, they wanted to buy a house, and now things go a little sideways, and there's been so many people that have exited the business. The ones that are still around are getting much better deals. We're seeing a lot of flips, and I talked to a lot of folks that are saying, hey, look, I'm going to buy a house for very little money out of pocket, and even though rates are higher now and my cash flow is not going to be great, I know that I'm getting a good deal. I know I'm not paying a lot of money for the property, and I know eventually rates will go down and rents will go up. And so I'm able to get into these properties for way less, by 3 versus 1, relative to the cash out of pocket they had to spend to get these deals.
What's interesting to me, and I don't, again, I this is my first time looking at this data, so I'm doing a quick scan of a lot of stuff. By the way, I feel like that guy on Monday Night Football that's kind of just chiming in on shit that kind of opposite of data and numbers. But the one thing that really stuck out at me is the days on market. If you look at Houston, days on market went up. If we look at Dallas, days on market went down. So that to me is an indicator. Someone that owns a property management company, someone that's buying and selling real estate. You said it correctly, Jeff. The velocity of money. How quickly will I get my money back? So this is 44 days. Houston is 47 days, but Houston has gone up. This is going down. So you think about that, and if you look at the dollar volume now, if you look at the economies of Dallas, very much like Houston. What is it that we see going into Dallas and Houston? We see companies, which means we see jobs, which we see high income jobs. I'll give you my perspective when we go to Austin. Now, I owned a office in Dallas, so I was very familiar, and Fort Worth, so I was familiar with the market. But the reason these are so steady is we're basically stealing market share from California, essentially, or the West Coast. So we're not creating new jobs, we're stealing jobs, which is great, you know. I mean, I'm from California, but I don't claim that originally. But the thing is if you look at this information, this isn't a bubble. These are jobs that are being injected into the economy, and they are high paying jobs, which is different than Austin. And we'll go to Austin in a second because I'm very familiar with that. Same with Houston. So this to me is not an anomaly. If we were to see these numbers in San Francisco, I would go, something's not right. This doesn't make sense because everyone's doing an exodus out of California for taxes and political whatever reasons. But if you look at this is in line with what we think. I mean, look at the median sales price. It was 264. Now it's 400. It's gone down $2,000. I mean, that's not even, that doesn't even move that. That's not even a flinch on the needle. So it's staying steady through everything. And I think it's going to keep being strong as long as businesses keep going in. And again, I'll give you a perspective, you know, with myself, you know, like I told you, I'm in Argentina right now. I get to travel the world. The one thing I noticed when I was owning my property management company, and I had the fortune of speaking, I did several tours in Australia about real estate and different parts of the United States. Everybody loved Texas. And what was interesting is I started tracking the data of all of our clients. 50 to 60% of our clients did not live in Texas or in the country. So I started thinking, why is it people that live in Texas are not taking advantage of these deals? We have blinders on, we don't see it. We're like, oh my God, look at those days on market. People in other countries are throwing money at these deals because they see the opportunity. So it's almost like a different lens they're looking at it. We're all looking at the same numbers, but again, I just go back to, it's telling us a different story based on, you know, where we're going with this. So this doesn't surprise me about Dallas because of the strong injection of businesses and the high income earning jobs associated with those businesses. Same thing in Houston. It's not surprising me at all.
Well said.
Let's dive into San Antonio.
Yeah. So San Antonio, I'll cover these numbers, and then Steve can chime in like the Monday Night Football guy. So there's 12,000 active listings, call it 2,400 sales. The average sales price $379 versus $382. So it's down 1% last year. Again, if you look over a 4-year period, it's up 36%. Median, same thing, down slightly year over year, up 35% over the last 4 months of inventory. Started to creep up a little bit to 4.5, which is a little bit higher than the other two. I think what Dallas was 3 and Houston was 3.6, so it's a little bit higher. And days on market are 66. So it's a little different market, San Antonio versus Houston, Dallas. There's just a lot more people in Houston and Dallas, to be honest with you. It's more robust. So I would say San Antonio has been, they're down a little more than the others. But again, relatively speaking, I see these same deals, or the great out-of-pocket deals in San Antonio as well for the investors that are buying deals. It's not any different. They're still getting these deals for really low numbers, like obscene if you would have said the same number 2 or 3 years ago. So yes, like I said, not as strong as the other two, but still very strong, relatively speaking, especially when compared to the rest of the country.
If I might add one thing there before I turn it over to Steve, to provide a little color to what Jeff's speaking about. Sometimes people perceive that home values have to drop for them to get a good deal on an investment property. But what's interesting about investment properties is that you don't pay retail, right? If you're buying a home and you're a typical home buyer, you're going to pay pretty much the retail price. You might get some slight discount, but for the most part, you're going to pay what the prevailing market rates are. Whenever you're an investor, people pay a percentage of the projected after repairs value. And the percentage that people are paying today with the higher interest rate environment is significantly less than it was in the past. So whenever Jeff talks about out of pocket, that's because a private or hard money lender like we are lends a certain percentage of that after repairs value. And if people in general, because less investors are in the market, maybe some people are nervous about the market, maybe some people are afraid of rates, there's less competition, you're able to get a steeper discount, right? And that's why Jeff's saying on average, people are paying 1/3 of what they were paying a few years back out of pocket, maybe half at most. And so investors are really getting much better ROI because of that number. Because you can't get overly focused as on cash flow if you're a long-term investor. ROI is the bottom number, right? That is what the bottom line really is. Steve, I see you shaking your head. I'm thinking you agree on that.
Yeah, you know what? I feel like I need like that the whiteboard with the X's and O's to start showing the plays of how they go. So I've got a couple perspectives, and again, I'm my background of doing a lot of creative real estate and bigger pockets, and coaching a lot, thousands of real estate investors over my years. You talked about motivation, and I just want to touch on that because you're so right, Wade. People think motivation is tied to money. Motivation is tied to a problem that they have. I would sum it up in 4 Ds: death, divorce, downsizing, and deployment. Those are normally the 4 Ds that causes someone to be motivated. The reason someone is motivated is because they are willing to trade time for money. They don't have the time to hold on to the property. Maybe they can't afford the mortgages. Maybe they're getting deployed. Maybe their job is going somewhere else. Maybe they're buying another house, whatever the case may be. And they are trading that for time. And that is their motivation. So many investors think, oh, someone's motivated, I'm going to offer them a lower price. I've owned a lot of shitty properties. I didn't care what it took. I just wanted it off of my plate because I didn't want the stress and the headache. The money had nothing to do with it. I just didn't want it to take up headspace in me. So I agree 100%. Motivation has nothing to do with money. That's kind of, I always tell people, that's your problem. That's your hang up. And that's probably why you're not where you want to be, is because you have a problem with money. Not saying you do, but that's normally the case. Now, I just want to talk about San Antonio. Now, whenever I've coached people in the past, I always look for what are the economic drivers of a city, right? Now, I like to see normally at least 2 economic drivers to a city. And in a down economy, which economies go up, economies go down, in a down economy, I like to see 3. So if we looked at Dallas or Houston, we've got the airline industries, we've got tourism, we've got a lot of things that are driving that. We've got big business going in. Well, when we look at San Antonio, what do we have? We have a lot of military bases and we have tourism. There's other contributing factors, but if you were to say, what are the 2 biggest drivers of the San Antonio economy? I would say military and tourism. Well, what happens in down economies? Tourism starts fading off. Military's good, right? This administration's shrinking it, so that may be affecting it. So this doesn't surprise me that these numbers are down because there's only 2 economic drivers. I mean, there's more. I don't want someone to start screaming that their uncle owns a business there, but there's basically 2 major economic drivers. If there was a big influx of oil, or there was, like in Dallas, you've got the 8 billion mile road of all these companies, that would basically influx capital, and there would be a capital infusion into the industry. High paying jobs would come in, but San Antonio doesn't really have that. So, and again, look at the numbers. You look at the days on market. Days on market are going up. You look at the other numbers. Things are going down. This trend to me is exactly what I coach people on. I'm not saying it's a bad thing, but remember, if some people go to let's just say, I don't know, Killeen, right? If you go to Killeen, we know Killeen is pretty much a military town. If the military pulls out of there, you're kind of in a bad position. That's why I don't like investing in one income driving cities. So to me, this makes sense because, and again, I could be way off. Maybe somebody knows something I don't, but I would say because it's a 2 driving industry in a down economy, we're just going to see a bigger dip. Not saying it's not going to come back. I think it will, but I don't think it's going to. I think it'll be affected more than places that have 3 and 4 income drivers.
Interesting perspective. Yeah. Let's dive into Austin. Austin and San Antonio are very close in proximity, but very, very different markets in many ways. And without question, Austin had the biggest run up, arguably in the country, before rates went up, and then they are more impacted. You look at this year-over-year number. All the other major markets in Texas are either flat or slightly up, maybe down slightly, down 8.4% year-over-year. That number was bigger earlier in the year. I think it got it maybe as high as 15% at one point. So Austin has been more impacted. But if you look at, and we don't have the pre-COVID is up 32.8%. So it was up over 50% at one point, but it's pulled back, right? So that is a very interesting number. And, Austin did have a tremendous amount of businesses moving in there, from Tesla and other companies moving in. But I think that just ran up too quickly and probably does not have as many different industries that are supporting it. Tech arguably has been the industry that's been most affected recently by the economy. Tech has had more layoffs than some other industry sectors. So I think that may be playing into this as well. But I do anticipate this bouncing back eventually, probably not as strong as Houston and Dallas, but I do see this negative turning around, especially if rates start to normalize. We're going to see Austin really picking back up again. What do you guys think?
Yeah, Steve, you said you had some awesome theories. I'd love to hear them.
Yeah, I'm just pulling them out of my ass. No, just kidding. Yeah, so here's my take on Austin. And when we were looking at expanding and opening an office in Austin, again, we looked at the numbers, we looked at the data. I wanted to know, what was the average house price, what was the average income, what was the average tenant age, right? And so there was a big disparagement because of the university there. There was a lot of people that they love Austin, right? So they go to Austin, they stay in Austin. Well, because there's so many university kids getting out, they can suppress the wages in general, right? I know specific jobs, obviously, if you're a VP for Dell, that's going to be different. But in general, people are willing to work for less money because they get to stay in Austin. So there was a big disparagement of what a house was worth compared to what they could get for rent because of the local income disparagement. And the average age was much, much lower. There were people that just graduated college that were staying there. So when I'm looking at a city, are we in God's waiting room like in Florida, or are we in a college town where we know they're going to be leaving soon? So I want to know, what does the average tenant stay for, right? Because that's going to affect the cash flow and all that other stuff. I think this was a very, very bubble type city. I think, listen, there's some cities that you go, it just can't keep going, right? Los Angeles, New York, the allure of the city keeps it moving. This may very well be that case. I think this is going to be one of those cities that, yes, it's going to come back. It's always going to be leading the pack. But as an investor, it's not going to be leading the pack on a cash flow basis. It's going to be what I call a negative geared property. I'm going to buy this property and I'm going to take negative cash flow on it, which is okay because I know it's going to be going up in value. So this is going to be a value play of appreciation, and I'm okay with that. Like, okay, I can buy $1 million house and lose 500 a month because I know in 5 years it'll be worth 1.8 million. Okay, I'm cool with that. I can sustain that loss. If someone is buying a property just based on cash flow, I would go, this is not the city for you. And again, this is just my opinion, but what I looked for was the average income of the tenants, average income of people buying the house. And I don't know what kind of data you guys have seen. And this was a couple years ago, so that may have changed. So, this was back in 2019, right before COVID hit is when we were looking to expand. And I wanted to see, what is the average time that a tenant stays, the average age of the tenant, the average income of the tenant. And based on, Dallas was actually the most central. Houston was right next to it, but Austin was way off the grid. And again, it's just something that we look at as to what is the investing strategy for this city. There is a strategy. You can make a lot of money. You look at the numbers on the right, 32%. Okay, that's a good hit. In 2019, it was worth 327. Today it's worth 435. You can pull 100K out of it, walk away. Okay, that's not a bad gig. And we all know it was much more than that at the height. So
Yeah.
I think this makes sense to me. But remember, this is a college town. What are the economic drivers of this town? It's a college. If it's a great town, guess what kids want to do? They want to stay in that college town. So you're going to see that disparagement. Not saying it's bad, but just realize what kind of investment you're getting into this.
Makes a lot of sense. Let's hop into this next presentation here. And so I want to give a little background on where this is coming from. So this is PwC consulting firm, and they have looked at the overall real estate prospects. And you can see that there's a couple different groups that they interviewed. So they conducted like 600 face-to-face interviews, 1,200 surveys that they had completed, and looked at every major city in the entire country. Great news is that we're all in Texas, and the four major metros in Texas rank in the top 11, with Dallas being third, Austin fifth, San Antonio 8th, and Houston 11th. So our opinions on looking at the numbers are a little bit different than what these prognosticators are saying, but it is a very strong story overall to see so many Texas markets ranked so highly.
I again, not to turn this into a fist fight, but I think a lot of these go along political lines. I think you see a lot of this on politics, and I'm not to go down that path, but you can clearly see. I mean, I know when I've coached people and they say, "Where should I invest?" I first want to know, is it a landlord friendly state or a tenant friendly state? That's the first thing I want to know. It normally goes along party lines. If just out of the gate, I don't want to. I grew up in California. I would never invest in California. It's just not. It doesn't make sense for me as an investor because it's not a landlord friendly state. So why even go into those choppy waters? So this makes sense. And again, then if you started looking at where people are going to, where are they coming from? Because some of the things I look at also is with me traveling the world, I get to meet a lot of people that want to park their money, especially in a hyperinflation area. They want to park their money. Where's the best place to park it? Park it in real estate. What country is the best place to park your money? Best place to park your money is in the United States. I'll give you an example. Can I just show you guys something? I went
Sure.
to I'm in Argentina, and I had to exchange $100 today, and these are thousands and 500s, and there's more. It's like a shoebox of money because of the hyperinflation of their money. So this is, let me see if I can get it all.
So you better go spend it.
Oh yeah,
Go spend it before it's worth less.
$100 US?
No, this is Argentinian pesos. So this is
Yeah.
what
What's the
Yeah.
how much does it translate to?
This was 90,000 pesos for 100 US. You
Wow.
can go out to dinner and drinks and whiskey and stuff for probably about 20,000 pesos at the tops. I mean, like everything. But my point is, the reason I bring this up is this is what hyperinflation it looks like. This is exactly, people talk about inflation, they can't relate to it. When you go to the money exchanger and you get a shoebox full of money because it's not worth anything, it's good, but it's not that good. So what do we want to do? We want to park it in a place that it can be protected, like the United States, and we park it in real estate. So so real estate makes sense. So the emerging, my point of that is the emerging trends that you're seeing. Don't assume these people are going from state to state. They may be coming in from other countries and injecting capital into these countries just to park their money.
Very interesting. Yeah. So this was the overall real estate prospects. Let's go to the next page, Jeff, and you can cover. This is little bit, the home building prospects, right?
This is for home builders. 31% of homes for sale are new builds. And if you look at this chart, I don't know. There's nothing. This is basically starting in 2000, but this is the highest it's been. Yeah, I guess it peaked a little while ago, but relatively speaking, this is a really high number for real estate. So tons of new builds are coming on the market. I was reading an article about they have the ability to offer so many incentives that regular sellers do not have. Talking about interest rates, reduced interest rates, free upgrades. It's a great time to be a home builder right now because you have less and less competition. And to that point, like you were saying earlier, Austin is the #1 market in the country for new home builds, followed by San Antonio #2, Dallas is 5th, and Houston is 7th. So, and if talking politics, or the top 9, save Washington D.C., are all more conservative type of areas. So, to your point, it's probably easier to build there, less restrictions. But it's great for Houston. I mean, great for Texas. 4 of the top 7 in the entire country are here in Texas. So if you're home builders, it's a good time.
Yeah.
You do any new builds, Steve? Any experience with that, new builds?
No, not really. I mean, listen, I think it's you drive anywhere in Houston and you're or any city really, and you're seeing these mega apartment complexes going up and everything like that. obviously maybe they see the bigger picture and I have the 3x5 card. But I think it's just a matter of, I mean, listen, it's just common sense. The population is growing and they're trying to get ahead of the curve. And last I checked, I think Houston was still behind the curve. That they still have not caught up with the population influx that's coming in. So yeah, this doesn't surprise me. They're not going to stop. We're looking at months. They're looking at decades, right? When they're building these things. So we have a micro look and we're like, oh my God, interest rates went up 7%, 4%, 5%. Maybe we should stop. They're not stopping. I mean, they're moving because the velocity of money is not going to slow down. And
Yeah.
so they are looking ahead at generations, not just this year. So they have a much bigger picture on this. So it makes sense.
Okay, we are we got to pick up the pace just a bit. So if we go to the next slide, I'm just going to briefly cover this. What we thought was very exciting about this article is this is still the PwC article. Very smart people, 1,800 people that are in the real estate space, and you can look. What this shows is the gray dot is 2023, the orange dot is 2024, and what this shows is the amount of positivity year over year in all these different categories of real estate investment. So, you've got mobile home communities, you got single family homes, multiple categories for single family. But the thing that was most exciting for me is all these very, very intelligent people, despite the fact that interest rates are higher today, see the prospects for 2024 to be very, very positive over 2023. And all of them are still pretty good on a scale of 1 to 5 because of the scarcity of homes out there and places for people to live. All of them, even at what people might have considered a little bit of a negative time last year, it was still always a 3 to a 4, and it's very close to a 4 right now. So overall, that's exciting. I don't know that we have a ton of time to get a lot of opinions on this one, but there's a couple other reports that we did really want to cover. Let's see, let's go to the next slide.
Was that a hint for me not to shut up and not say anything?
No, not at all, sir. Not at all. You're doing a great job. We're just trying
gonna keep clicking so Steve doesn't keep talking.
No, so
They see us all the time. They don't see you very often, so you feel free.
So this one is just the Zillow report on the 10 most attractive cities if you're single and renting. So, Steve, you were talking about this, the younger impact, right? So it's interesting that Austin is ranked second. This is the first report I've seen where Austin was ranked higher than the other major metros there. So I think this is for a renter's perspective. So tell me what you think.
What was number one?
Wichita, Kansas.
No shit.
Yeah. So one thing I did read that was interesting, they said Dallas, Texas has more single people than any other city in the entire country. Dallas, Texas.
Really?
Yep.
Huh. Interesting. I got nothing on that one.
Next slide, please.
Yeah, this one kind of gets back to what you were talking about earlier, where you want to find places that are conducive to what you want to do. You want to invest, you want to make money. This is business friendliness, but it ranks the states as the most or least business friendly in the country. Then there's a methodology there, business environment, cost of doing business, funding and resources available. But to no surprise, Texas is 1, Florida 2. Mexico 3, I was a little surprised with, but and Oregon 4, to be honest. But if you look at the color distribution, it looks like the kind of the same smile that we saw previously, where if you are a business friendly state, it's going to positively impact your real estate market.
Yeah, and I think and again, it depends on how they're measuring it and what the metrics are. I remember back before it used to be number 10 based on the best tax business friendly, but the GDP for Texas was stronger than all 9 of them together. So it was because we have a franchise tax. They said if we didn't have a franchise tax, we'd be number 1. But because Delaware, Wyoming, Alaska, they don't have a franchise tax, so they were the most tax friendly business. But Texas eclipsed any other financials because of their GDP of the state of Texas.
Yeah, it's interesting that Texas is actually a full 5 points, and we don't have the detail on all of the different measurements here, but it's a full 5 points, like 65 to 70 there.
Oh, yeah, you're right.
Above number 2. So that's a big jump. And everyone else is kind of bunched up around 65. So
Yeah,
very, very positive outlook for the business climate for sure.
dark purple.
Yeah.
Next slide. This is just I'll cover this very briefly. Apple built a 133-acre campus in Austin. Tesla's planning a $770 million expansion of its Texas Gigafactory. Already has 10 million square feet. And then, Meta is planning to establish a big facility in Temple, Texas. The biggest one, this Samsung, $17 billion semiconductor manufacturing facility. I guess this, Taylor, that's outside of Austin, we saw, right?
Yeah, it's up by Austin.
That is a massive project, 17 billion. So a lot of job opportunities moving in the market to keep the real estate market up and high. And then let's go to the next slide. I did want to deep dive this a little bit more, get Steve's opinion on this one. So if you look at this, so this is the business climate overall, and it's ranked on 10 criteria, including corporate site selectors, qualified projects, and independent measures of a state's attractiveness to capital investors. Texas also ranked number 1, right, again, and you see total 410 points on the far right side. Next groups are jumbled up somewhere between 360 and 300 in the top 10, but Texas being a full 50 points above the next group. So 2 independent evaluations of the market, both showing very strong things again there, Steve. Anything else jump out for you on this particular chart?
No, I mean, again, I not to be political. I think a lot of it is party lines, and a lot of it is business climate of the individual state of do they want new influx of business? There's some states they don't want to grow new businesses. They don't have the capacity. Obviously the ones that we see at the top do. I don't see Florida. Florida's number 8. That surprises me.
Yeah.
Yeah, that kind of surprises me. But no, I mean, listen, I think business, it's a flow, right? It's going to flow. There's a reason so many businesses are coming to Texas. It's not the weather, it's not the mountains, right? It's the business climate. That's why, because they know that they're going to be treated better, treated special, and they're going to be taken care of. And so it's common sense. After a while, big business is moving. I mean, look, even Facebook, Amazon, all these people are leaving these states because they're just tired of getting squeezed.
Yeah, for sure. Anything to add on that, Jeff, or you want to go to the next slide?
Nope, next one.
Next slide, okay.
So this is just talking about interest rates. I know we mentioned it earlier as it being a potential springboard into a lot more activity when it comes to real estate and those numbers. But the chief economist for NAR, Lawrence Yoon, says home sales will raise by 13.5 next year, and rates will be between 6 and 7 by spring of 2024. So that would be a drop, obviously. And I think we all agree if rates start dropping, affordability goes up, and the folks that were looking to buy a house that just couldn't afford it will dive back into the market. So this is good.
Yeah, I agree. And listen, it's a pendulum. It swings, right? It's never going in one direction forever.
I mean, it's good, but honestly, it's gonna. If you're an investor, you want to get the deals now, because when that happens, I suspect a lot more folks will be jumping into the pool again. It's going to drive competition. It's going to drive demand for those deals, and the cash out of pocket is going to go back up. Your leverage will be less valuable.
Absolutely.
Yeah. Cash flow will be greater because rates are lower, but ROI will not be that much better because your cash out of pocket is going to go through the, not through the roof, but it's going to go back up to the levels before rates went up, and in fact, that ROI.
Yeah, and one thing we didn't talk on, I couldn't find, they said the article would be out 15 days ago. I couldn't find it, but rents just in Houston in general are significantly up. Like those are climbing. So it kind of goes back to the previous theory of, if you buy those deals, even like Steve said, with negative cash flow or very little cash flow, eventually those two things, the rents going up, rates going down, are gonna correct that for you.
So real quickly on the next slide, we'll just show that rates are 7.81% on average at the moment. that is historically low before the 2000 year, but definitely high in comparison. And that's the big difference at the moment, is just there are a lot of people who have that 2.5–3% rate that don't want to sell. So there's scarcity. That's why there's not as many sales taking place at the moment. This next slide is one we've shown a couple times. We go to that. I want to deep dive that a little bit more. You can see this orange line shows the number of units being built, and then we also have
the orange is the population and the blue is the build. Yeah.
I'm sorry. Yeah, I got that.
That's okay. So it kind of points to what Steve was saying earlier about how we have a long ways to go to catch back up.
For sure. Yeah, you look back in the 50s, the population was, 120 million. We're now up to almost 360 million. And then we're just not building many more homes than we did in the 50s, 60s, 70s. I mean, this chart always amazes me that we're building comparable amount of homes to what we were 30, 40, 50 years ago with a population that's literally, 3x or 2x, depending on the time frame you choose. So
yeah, and I remember. Sorry, I didn't mean to cut you off, Wade.
No, you were.
I remember that the 80s actually was where they started getting kind of like a boat, right? They got behind the power curve in the 80s. And they just have never recouped from the 80s. They really didn't do much building, in the 80s, really. And it kept, people started steamrolling in. And if you look at, 2010, it dropped comparable to 1980. But how much bigger was the population relatable to the two, things? But it dropped almost equal. So they're behind the curve. I mean, that's. I mean, look, if you look at 99 and all the stuff going up there, I mean, there's a lot of construction, not because they don't know it, they're doing it because there's a need for it.
For sure. Yeah. I think that's and to Jeff's point, whenever those rates do inevitably come down, I think there's going to be a huge increase in prices. I definitely see that. Next slide, rental vacancy rate. This really aligns with the historical numbers. You can see that the vacancy rates are always lower whenever rates go up. It's harder for people to buy homes. They really want rental property, so that's a positive for us at the moment. As rates come down, there might be a little bit more vacancy, but vacancies are very, very low. And the time it was comparably low in the past, it was definitely a very high interest rate environment from the 70s to the mid 80s there. Jeff, Steve, anything on this chart that speaks out? Or we'll go with the affordability index.
No, like you said, when it's easy to buy houses, people don't rent, and when the inverse happens, they do. So that's why I think that number is going to keep climbing until it gets easier to buy a house.
Sure. So that last slide, Steve, this is affordability index. Basically, it's actually a lack of affordability index. The groups at the top are unaffordable. Anything jump out at you here?
No, I go back to, if you look at Austin, right, the household income, and again, my numbers were taken a while ago, and you look at other cities, right, you look at the house prices. So look at Austin and Dallas, right? Austin, the home price was $540, average income was $88,000. Dallas, it's $370. It's almost $200,000 less, but it's only $20,000 a year income less. So, and look at Houston. So the disparagement, it was even more before. But that's what that tells me. So that's kind of where I was getting the data when I was looking to put another office. That was the challenge.
I was just saying, if you look at the difference in income in Austin, to your point, like just 4 years ago, the income in Austin was $63K. It's up to 88. Like that's a massive spike.
It's a huge, yeah, and that has to do with a lot of the businesses that are coming in and stuff. Yep.
Yeah. I mean, the other ones, Dallas and Houston grew. I'm sorry, Dallas and Houston grew, but not nearly as much as Austin.
Yeah. That's a 25K jump, and Houston is closer to 15. So big boom there. Yep. That's a lot of those high-tech, high-paying jobs for sure.
Yeah.
Yeah.
One thing that's always interesting to me is that as rates have increased, one more thing there, you see that like Houston, if you look at the history, Houston was the 26th least, 26 on the chart back in October 2019, 36 October 22. It's down to 44. So we're talking one of the 5 or 6, 7 biggest cities, most amenities, great things across the board, but still incredibly affordable in Houston. Dallas, still very affordable relative to a lot of the other cities that have comparable amenities. So that's another reason that we really see San Antonio also very affordable. You're talking top-notch cities with a lot of amenities that are much more affordable than the other top cities in the country. Anyway, Derek, are there any questions today from the attendees?
We do have a couple of questions today. So first one is, how should a new investor approach the current market, distressed or turnkey, buy and flip, buy and hold? So many options. How should a new investor approach the current real estate market, distressed or turnkey, buy and flip, buy and hold?
I was going to say if anyone else had a thought, I have a thought. I think for newer investors, you just don't want to dive straight into the deep end of the pool right away. You want to build out your team. You want to build out your skill set. So in my opinion, starting off with a rental that's at a price point, a flip where you're at a price point where you could rent it. We're starting off with a reasonably priced rental that does not require like expert level craftsmanship. I see people sometimes come in and they want to do this amazing flip and start off at a really high price point. That price point can be a little bit unnerving at times because the interest rate environment we're in and those homes don't always move as quickly, but even more so, it's really building out your skill set. Sometimes people don't understand that this is a skill. There are home builders that are very good because they build great homes, and there are remodelers that are very good because they remodel great homes. So building out your team and your personal skill set is extremely important. So just starting off with a more reasonable investment, either in a rental or a flip category, makes sense to me.
Yeah, I would not do turnkey just because you're going to pay retail prices and it's a lot of cash out of pocket. And investment deals, like I said, are so low out of pocket right now, you can get way more bang for your buck. Just like to Wade's point, don't grab a massive rehab. I would have, if you're new, do not go get a $90,000 rehab. But I would not do turnkey if I'm wanting to maximize my dollars.
I say push all in. No, I'm just kidding. Don't do that.
Shove.
My only suggestion, and I see this a lot with real estate investors and even business owners, start with the end in mind. First, understand, why are you buying these? Why are you flipping? Why are you doing that? What is it that your life is going to look like as a result of owning these? Properties, real estate, these are just strategies to get you to a goal. So you've got to define that goal. It's got to have a day, a month, and a year. So you may say, in June 1st, 2027, I'm going to have a $10 million portfolio giving me a 35% return, and I'm going to be working 3 days a week. Okay, now we have a destination. It's like driving in your car. You drive in your car with a destination in mind. Buy real estate with the destination. All this other stuff, it should align with your end goal. When you come to me and say, Steve, should I buy this house? I'm going to say, what's the goal? If it doesn't align with the goal, you don't buy it. If you don't know the goal, then you don't start going down the path. So I recommend start with the end and work it backwards is my suggestion.
Great advice.
Okay. Steve, so I see your website on there. What can people find at steverozenberg.com?
Yeah, if you go there, you follow me on social media at steverozenberg.com. I do every month. I do 2-day business coaching classes. Here I do them in Houston. People flying from all over the country. It's very small. It's only 20 people allowed to come. People. I've got bigger pockets. People coming in all the time. Ashley Care, other people come in. But if you want to learn how to build your real estate portfolio to run it like a business so that it runs without you, just go to my website. I got videos. I got stuff. I got a lot of free stuff on there, but I'm all about abundance, helping people out. If you send me a message on social media, I'll give you an answer. As Wade knows, I'm very accessible. I think it's all about abundance and trying to help all of us get further down the road They say if you want to go fast, go alone. If you want to go further, go together. And I'm a big believer in going together. And guys, thanks for having me on today. I appreciate it. Hopefully I added some color, some insight, and then some good perspectives on this.
Go spend those dollars, man. They're not going to be worth much if you sit here in the hotel room.
That is happening, man. There's some steak going down tonight.
Just slam a huge stack of money on the table.
Give me everything.
Let's make this. Let's light this candle.
Are you buying a vehicle, or are you paying for steak?
Yeah. Anyways, guys, I've got to go. So thank you so much, and appreciate it. And wish everyone here good investing, and good luck to everyone. Thanks, guys.
Thanks, Steve.
Bye-bye.
Bye.
Let's do the award winner, and then we'll let everybody go as well, Derek.
Absolutely. Every time we do a real estate market update, we have one lucky winner, and you have to be on the webinar live to win. And the winner of today's half off of your next hard money processing fee is Rusty Manning. Rusty Manning.
Good job, Rusty.
Congratulations, sir. All right.
Thank you, everyone, for joining us.
Thanks. Happy investing. Have a good one.
Next real estate market update. Absolutely. Goodbye, everybody.